Hello everyone, today with MarketXLS we're going to talk about a popular options trading strategy known as the laddered call option strategy. MarketXLS is one of the top Excel-based investment research solutions for investors. It makes it easier for you to turn your Excel skills and market knowledge into profit. In this video, we'll be learning about what a laddered call option strategy is, how it works, when to use this strategy, what are the parts of this strategy, and how MarketXLS can help you in implementing this strategy. So without wasting further time, let's start with the topic. The laddered call option strategy is also known as the bear call ladder option strategy. This strategy covers three aspects of the options related functionality. It is one of the option strategy which is used by traders when they expect the market to move. The direction doesn't matter. It is a direction-neutral strategy. It is a three-pronged strategy where the investor goes long on the out-of-the-money call option and goes long on the at-the-money call option, but he goes short on the in-the-money call option in the same expiration month. Three things are to be noted here. Both the options must have the same expiry date. The options are bought or sold in equal quantities in the same expiration month, and they must belong to the same underlying asset. MarketXLS offers a template for this strategy. Here's an introduction page and here's an active template. The yellow cells have to be inputted by the user, so the stock ticker expiry date, out of the money call strike price, and the spread. The spread in this case represents the difference between the higher and lower strike price of the two call options. A table of upcoming expiry dates and current share price is available for the investor's reference on the right. And for the purpose of this video, we'll be using Apple. Expiry date as 23rd July. We'll be buying an out-of-the-money call at 130 strike price, and the spread is 5. And now in order to hedge our position, we'll go long on the at-the-money and out-of-the-money call option and short on the in-the-money call option. The net cash flow of the whole strategy is the sum of the cash flows provided by all the three options. It will always be positive in this strategy, and the amount will also be equal to the strategy gain in case the market goes down. MarketXLS has many templates just like the laddered call one that you see here, and it refreshes all the data when you click on Refresh All. MarketXLS offers a net payoff table and a net payoff diagram to help the user observe the potential profit or loss at different expiry levels. As we can see, if the stock price goes down, the gains will be capped, and that would be equal to the overall premium credit while setting up this strategy. If the stock price goes up, the gains in this case will be unlimited. The maximum loss in this case is capped, and it happens when the option expires anywhere in between the at-the-money and the out-of-the-money strike price, and the amount will be as calculated in the net payoff matrix. Hence, we can conclude that maximum loss is limited and maximum profit is unlimited. That is all for today. We hope we were able to help you understand how to use MarketXLS for the laddered call option strategy. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.